Imagine this. You finally decide to sell your silver. Not all of it, just enough to lock in what feels like a well-earned win. You held through volatility, you ignored the noise, you waited patiently, the price moved in your favor, and for a moment it feels like you made the right call. Then, a letter arrives, or a notice, or a quiet realization when tax season comes around, and suddenly a large piece of those profits no longer feels like yours. This is the moment many silver investors never see coming, not because they were careless, not because they did anything illegal, but because the rules around silver are very different from what most people assume, and those rules can quietly turn a smart investment into an unexpected tax shock. Today, we're going to unpack the hidden mechanics behind what many investors call the 28% tax trap. Not with fear, not with hype, but with clarity, context, and calm understanding. Because this is not about avoiding responsibility, it's about knowing the game before you play it. Silver has always carried a certain mystique. It feels tangible, real, honest. You can hold it in your hand. It doesn't rely on promises or algorithms or earnings calls. For centuries, silver has been money, protection, and insurance all rolled into one. And that's exactly why so many people turn to it when trust in systems begins to wobble. But here's the twist. The same system that makes silver attractive as a hedge also treats it very differently when profits are realized. And most investors don't learn that until it's too late. The issue begins with how silver is classified. In the eyes of the tax authority, silver is not treated like a stock. It is not treated like a business investment. It falls into a separate category altogether, a category with its own rules, its own rate, and its own logic. That logic comes from history. Silver, along with certain other physical assets, has long been labeled as a collectible. The term sounds harmless, even flattering, but when it comes to taxation, that word carries real consequences, because collectibles are subject to a special tax structure that overrides what many investors expect. This is where the trap quietly forms. Many people assume that long-term investing always leads to favorable tax treatment. Hold longer, pay less. That's the story most of us learn, and for many asset classes, that idea holds true. But silver plays by different rules. When silver is sold at a profit, that gain may be taxed at a higher rate than stocks, bonds, or other common investments, even if it was held patiently, even if it was part of a long-term strategy, even if the sale was carefully timed. The rate can be surprisingly steep. And what makes this more unsettling is how rarely this reality is discussed in mainstream investing conversations. Silver is often marketed as a safe haven, a shield against inflation, a store of value. All of that may be true depending on perspective, but the tax implications are often buried in fine print, mentioned briefly, or ignored entirely. This is not an accusation, it's an observation. Many investors focus on price movement and forget that profit is not just what you gain on paper, it's what you keep after the system takes its share. Now, let's slow down and look at how this plays out in real life. Imagine someone who bought silver during a period of low confidence in the financial system. They didn't trade it actively, they stored it safely, they watched markets rise and fall. Over time, the value of silver increased. Eventually, they decided to sell. At that moment, the gain becomes real, and that's when taxation enters the picture. Unlike assets that enjoy preferential treatment after long holding periods, silver may be subject to a higher maximum rate simply because of its classification. It doesn't matter how disciplined the investor was, the classification overrides behavior. This surprises many people. Some reports suggest that this classification exists because collectibles were historically associated with luxury or discretionary items. Art, rare coins, antiques, items not seen as productive investments but as personal assets. Silver was placed into this group long ago, and the rules have followed it ever since. Whether that reasoning still makes sense today is a matter of public debate, but the rule remains. And the rule has teeth. Because silver is often bought by people seeking protection, stability, or independence from traditional systems, the realization that profits may be taxed more aggressively can feel ironic, almost contradictory. This brings us to the emotional core of the issue. It's not just about money, it's about expectation. Most investors are not trying to avoid taxes. They want fairness, they want predictability, they want to understand the rules clearly enough to make informed decisions. When those rules feel hidden or counterintuitive, trust erodes. And that erosion matters, especially in an environment where more people are exploring alternative assets, hard assets, and physical ownership. Now, let's introduce a critical nuance.
Not all silver exposure is treated the same way. Physical silver, such as bars and coins, often falls squarely under the collectible classification, but certain financial instruments tied to silver may be treated differently depending on structure. This distinction is subtle, technical, and easy to misunderstand, and misunderstanding it can be costly. Some investors assume that because their silver exposure feels indirect, it will be taxed like a traditional security. That assumption can break down quickly depending on how the asset is structured and regulated. This is why blanket advice around silver investing can be dangerous. Context matters, structure matters, intent matters, and the tax code does not care how emotionally attached you are to your investment thesis. It only cares about classification. Here's where things get even more interesting. Many investors don't realize that selling silver is not the only event that can trigger tax consequences. In some cases, exchanging one form of silver exposure for another may still be considered a taxable event. The rules around like-kind exchanges have evolved, and assumptions based on older practices may no longer apply. Again, this is not about fear, it's about awareness. Because awareness gives you options, and options give you control. At this point in the video, some viewers may be thinking, this feels complicated, and that reaction is understandable. Taxation is rarely intuitive, but complexity does not mean inevitability. There are legal, ethical ways investors plan around this reality. Timing, strategy, and professional guidance all play a role. The key is knowing that the issue exists before decisions are made. And this brings us to a moment worth pausing on. If silver is meant to be a hedge, a form of protection, then planning for taxation is part of that protection. Ignoring it leaves one side of the fortress unguarded. This is where the secondary hook comes in, because the most dangerous part of the 28% tax trap is not the rate itself, it's the assumption that it doesn't apply to you. Many people believe they'll deal with taxes later, when they're older, when they sell everything, when the system changes, when circumstances are different. But taxes don't wait for convenience. They activate at the moment of realization. And that moment often arrives unexpectedly. A medical expense, a business opportunity, a family need, a market move that feels too good to ignore. When that moment comes, the rules are already set. Now, let's take a step back and look at the broader picture. The treatment of silver reflects a larger tension in modern finance. The line between personal assets and investments has blurred. People collect assets not just for enjoyment but for protection. They diversify not just for returns but for resilience. Yet the tax framework hasn't fully evolved to reflect this shift. As a result, assets like silver occupy an uncomfortable middle ground, loved by those seeking stability, treated cautiously by regulators, and taxed according to categories defined long before the current financial landscape existed. Some analysts argue that this discourages long-term holding. Others suggest it pushes investors toward paper alternatives. Still others see it as a neutral outcome of a complex system trying to balance incentives. There is no single interpretation. What matters is understanding where silver fits today, not where we wish it fit. And understanding that means accepting that profit is not just price minus purchase, it's price minus friction. Tax is friction. Now, here's something rarely discussed. Even when investors are aware of the higher tax treatment, many underestimate its emotional impact. Watching a significant portion of gains redirected can feel deflating, even if it was expected. That emotional response often leads to rushed decisions, regret, or second-guessing future strategies. That's why education matters, not to eliminate emotion, but to prepare for it. When you know the rules in advance, you're less likely to feel blindsided, less likely to react impulsively, more likely to integrate tax considerations into a broader plan. And planning changes everything. It transforms silver from a standalone bet into part of a coordinated strategy, one that considers timing, income, goals, and legacy. This is especially important for those who view silver as generational wealth. Passing assets forward carries its own considerations. Rules around inheritance, valuation, and reporting can further shape outcomes. Ignoring these layers can compound surprises down the line. Again, this is not about fear, it's about respect for complexity. Silver deserves that respect. As we move toward the final stretch of this discussion, let's reflect on why this topic resonates so deeply. The 28% tax trap is not just about silver. It's about the gap between perception and reality, about how systems quietly shape outcomes, about how informed decisions require more than surface-level understanding. It's a reminder that independence requires responsibility, and responsibility begins with knowledge. No one is saying silver is a bad investment. No one is saying it doesn't have a place, but ignoring the tax structure does not make it disappear. In fact, ignoring it strengthens the trap. The investors who navigate this landscape most effectively are not the ones chasing hype. They're the ones asking uncomfortable questions early, the ones reading beyond headlines, the ones treating taxation as part of strategy, not an afterthought. If there is a single takeaway from this entire discussion, it's this: silver rewards patience, but preparation determines what that patience is worth. As we close, take a moment to reflect on your own approach, not just to silver, but to investing as a whole. Are you factoring in the full picture or only the parts that feel exciting? Are you planning for outcomes or reacting to them? Awareness doesn't remove risk, but it changes your relationship with it, and that change can be powerful. If this conversation helped you see silver through a clearer lens, take a moment to support the channel. Like the video so more people can discover this discussion. Subscribe if you want deeper, thoughtful breakdowns like this in the future. And most importantly, share your thoughts in the comments. Have you encountered surprises in investing that no one warned you about? Your perspective adds value, and the conversation continues there.